What is up, all you real estate loving individuals? This is episode number 39 of the Real Estate Take Podcast, and I'm your host, Wendell Butler. It's a go-to podcast for tons of information regarding the current real estate market, where we get various real estate professionals' current take on different areas of real estate. For today's guest, we have John Casmon. John Casmon is a real estate entrepreneur who has partnered with busy professionals to invest in over $145 million worth of apartments. He hosts the Multifamily Insights Podcast and is the co-creator of the Midwest Real Estate Networking Summit. Prior to becoming a full-time investor, John worked in corporate America, overseeing marketing campaigns for General Motors, Nike, and Coors Light, which is pretty awesome. So let's get John in here. John, how you doing?
Hey, I'm great, man. Thanks for having me today.
Yeah, thanks for coming on. I mean, you have such a wide variety of just like experience in your career, all the way from being like a marketing campaigner for some of these huge businesses and corporations, all the way to buying a ton of apartment complexes and building your real estate portfolio and helping others build a real estate portfolio too. So I'm excited to just get into it from all aspects of that, because I'm sure you even took some of the like marketing ideas from General Motors or just your experience from there to like help you market your real estate too. So it's cool to just dive into that a little bit. So what I like to do just to start is, I know I read your bio, but that's not your true backstory and everything. So I just leave the floor up to you to kind of introduce yourself, let the audience know who you are and what got you into real estate and just things about yourself. I'll take it from here.
Yeah, man. Well, I appreciate it. Thank you for the stage, man, and the opportunity to be here talking to all of your wonderful listeners trying to grow and scale their real estate portfolio. I was like many of your listeners starting out. I was a guy trying to figure out how the heck do you break in? You mentioned my time in corporate America. I spent 15 years doing advertising and marketing for some of the brands you mentioned. Worked at Buick, worked on Pontiac, worked on GMC brand, did a lot of work there, moved over to the agency side and worked on brands like Nike, Coors Light, Mountain Dew, some of the ones you mentioned. And for me, it really came down to recognizing that my day job wasn't guaranteed. I mean, I was crushing my career, but I was a GM at the time we went through bankruptcy. So I experienced that firsthand. So when I moved to the agency side, part of that was to develop, skills and work on different brands, because when you're marketing $50,000, $60,000 vehicle, it didn't seem that transferable to me, right? Like it's hard to figure out, okay, how do I take that and apply it to other products, other services? So I wanted to move on to other things just to be more well-rounded as a marketer. And ultimately, the agency I was at, that company ended up going into bankruptcy as well. And I'd started already investing in real estate, but the strategy I was doing just wasn't giving me the full traction that I needed. And that's when I realized I needed to make a change. As you talked about, for me, I've been able to scale that portfolio. To date, we've invested over $150 million worth of apartments, and we continue to scale that. So excited to dive in and share more about kind of my story, my journey, and how we were able to overcome some of those challenges we faced in those early days.
Yeah, for sure. So the cool thing about your story is obviously you were working in your corporate America and you were also starting like investing as well on the side, which I tell everybody that's what you should do before taking the full leap, just to like get your feet wet, understand if you even like it, and then kind of build just like your side business, real estate business, and get an understanding of how to then propel it forward once you take that full leap. So if someone was like in your shoes, say they're working for a great company in corporate, they're making great salary, but they know like they just want more, they just want freedom, they just want like the next step and more control, right? Because you talked about how working in corporate America, like at the drop of a hat, you could just lose your job. And that's not a fun feeling, especially when the economy is kind of rough, especially nowadays, right? So if you could just touch on kind of like your mindset and how you got going in real estate as you were working your full-time job, and like what barriers did you have to overcome for that? And how did you progress it slowly or forward to then make that leap or that jump?
Yeah, there were two major hurdles, right? So the first one was, how do I get started, period? And that was when I was in Detroit working at GM, watching the company go through bankruptcy. And I realized, man, at any moment, this could be taken away from me. Now, I was pretty young and early in my career, but I watched people who were lifers who had that happen to them. My dad was a blue collar worker and I watched him go on strike, being a union worker as well. So I kind of had some experience and a little bit of knowledge of what to expect. But when you're there and you see the folks around you and the morale just goes completely down because everyone's just worried about their own job, and you're at a large corporation. And by the way, we've done everything the right way. First one in my family to go to college. I went to college, got my degree. I got this nice corporate job. I'm sitting at headquarters. I'm working on these huge marketing budgets and campaigns, and I'm still worried about my job, but the job security. money. So it just made me realize that, man, this dream that we were sold is not real. There's components of it that certainly can pay off. And I'm not saying there's anything wrong with it, but if you have a great job, you're making good money, that's incredible. You still need to plan for the circumstances you can't control, because the reality is you can't control whether or not your company goes bankrupt. I mean, you can obviously make the decisions you're empowered to make, but unless you're the CEO, you don't have that power, right? So you can't control those things. You can't control whether or not you're just not someone's guy, which again, when I was at a large corporation like that, there's a lot of backdoor politics where somebody has made promises to someone else, or that's just his guy. And everywhere he goes, he brings his number two. And if you're not that person, if you're not playing the political game, you could very easily be pushed to the side or miss that promotion. And now you've got these feelings of, yeah, you got your job, but maybe you don't have that same passion that you had, because you realize they're just not playing the game fair. They're not playing it based on actually what you produce and bring to the table. It's other stuff that's coming into play. And that can wear on somebody after a while. So there are a lot of different factors, not to mention health, your own health of family members, friends. Life happens, man. And there are things that you can't control. And when life happens, if you're not in a position to be able to adjust, that can hit you pretty hard. So I was just talking to somebody last night at an event I was speaking at, and they mentioned something like that, where they were doing well, enjoyed their career, had a medical issue, and that medical issue really derailed their career because they weren't able to work. So you want to plan for that, right? You hope it never happens, but it's so much better if you have either passive investments, equity in other projects, something else to hold you over. So I started to just really think through all these things as I was watching it play out real time. And there was a gentleman that I worked with who would come into the office pretty cheery, considering everything going on. He was pretty chippy every day and had a great attitude. And one day I just said, hey, man, I'm going to go downstairs and get coffee. Would you walk with me? We walked, and I'm like, hey, man, like everybody here is stressing out. And you the only dude I see who's got a smile on his face every morning. Like, how are you able to stay so positive? And he told me that he enjoyed his job. So he was always thrilled and happy to come to work, and he brought that passion, energy. But the truth is, he didn't need it. He had other investments that had him taken care of. He was set for life because of his real estate portfolio. And that really just taught me the importance of building your own portfolio, building your own assets on the side, even if you have a great job. So that was the first time that seed was not just planted, but planted and watered. I'm like, all right, that's what we need to do. We got to build our own portfolio. So it took a minute to get some traction. Keep in mind, I'm in Detroit. This is 2009, 2010. Like, nobody's trying to buy real estate in Detroit at this time. They're giving away properties for $1. They're like, if you pay the tax, you can have it. So nobody is sitting there trying to buy properties in Detroit. And I didn't know anything, but I can tell if they're giving it away for free, it's probably not a great deal, right? There's a catch somewhere. So I'm like, you know what? I don't know enough to jump in here. And I knew I wanted to move to Chicago. So I got married. My wife and I settled in the city, and then we bought our first property there. So that's how we got started. But it was a lot of connecting with people, networking, reading, listening to anything I could on a real estate topic, just to start to formulate my own opinions.
Yeah, no, that's a great story, because not only did you talk about like just your headspace in corporate America, going through those struggles and stuff that people might be going through right now, but the fact that you took initiative and kind of like asked that guy that was happy and cheery and just being like, hey, what's going on? And like trying to like figure out his mindset on things. And then he found out that he had other investments or whatever securing him. That's great initiative. And it's also like, I mean, he had what I call nowadays just like FU money, right? It's like you have enough that you just don't really care. Like if someone fired you, you'd be like, cool, I got time to go find another job. I don't even need this job. And that's like where you kind of want to be. And I feel like that's what everybody's goal kind of is in a way, because you don't want to be controlled. Nobody likes being controlled by like your 9-to-5, by a corporate job, by anything really. So the more freedom we can get, the better. But so when you got into real estate and like buying your first properties and getting going, did you start small, or did you kind of dabble in different types of investing? Did you start with like fix and flips? Did you start with like small rentals? Did you start with, or did you just jump right into like apartment complexes and stuff like that? Like how was your growth, and like where did you kind of realize like this is the path I wanted to go based on like the niche that you kind of decided? Yeah.
So everything I read, I was always intrigued by multifamily, right? And everything I read said, I wish I started in multifamily sooner. Every investor, every book, everything I read, anybody who was in multifamily, they all said they wish they started multifamily sooner. So I had the mindset that I was always going to just start in multifamily. For me, that was really small residential multifamily. We started with 2-unit 2-unit building and we house hacked. And at that time, it was starting to gain some traction on bigger pockets. That term wasn't really used exactly then, but now it's something that's very popular. Brandon Turner made it really popular as well. But that's what we did. We bought a 2-unit building in North Center, a neighborhood in Chicago, lived in one unit, rented out the other. And my mindset wasn't that I was going to develop this huge real estate portfolio, but it was, hey, let's test this and see. And at that time, I was paying $1,500 in rent. So I'm saying me and my wife, we're paying $1,500 in rent. And when we bought this property, when we ran the numbers, our monthly mortgage was going to be $1,900. But the first floor tenant was paying $1,400 in rent. So in my mind, I'm like, listen, it's a net $500 in rent that I'm going to have to pay. I'm going to be saving $1,000 is how I rationalized it in my mind, right? I'm saving $1,000 a month. This is great. I knew that there was upside and equity and all that stuff you read about, but to me, that wasn't real. Just felt like, yeah, sure, over time it goes up in value, but it felt more speculative. So I really looked at it more from a standpoint of, I pay $1,500 in rent. If I buy this property, my note is $1,900. That tenant pays $1,400. I got a $500 balance. I'm going to save $1,000. So that was the mindset. Went in, we bought that. We did an FHA loan. We had saved a lot of money. I didn't realize that we only needed to put 3.5% down. So we used the extra money to renovate. We renovated the unit we were moving into, some of the exterior. And about a year later, we were ready to make another investment. And our real estate agent said, well, I think you got a lot of equity in that property. And we're like, no, we don't think so. We just bought it last year. She's like, no, I think you do. And we were really, really reluctant. She finally pushed us to talk to one of her lenders and just see what the property was worth and get an appraisal. What we did, and I was absolutely floored with what came back. We had created well over 6 figures worth of equity on an investment that we had just made the year prior, partially due to the overall economy going up, but a lot was actually driven by us and investing in the right location and making the renovations that we made to the property. And that was the moment I realized this real estate thing really works. And if you have a sound business plan, you can scale. So my mindset started to shift to say, how can I do more of this? So we ended up buying a 3-unit building. We bought an 8-unit building. And then from there, we actually scaled larger into commercial.
Yeah. No, I love how you dumbed it down a bit, because I think people overcomplicate real estate nowadays. They start thinking, they hear all the terms, right? That's like a good tax strategy. It's like appreciation. You get cost segs, you get depreciation, blah, blah. And it's like, when you first get started, I always say one of the best ways to get started is like a house hack, right? And just look at the numbers. Just look at like how much you're paying in rent versus how much you would pay for this mortgage versus how much you pay for that mortgage minus the rent that you'll be getting, right? And if you just do that math, you're like, hey, I'm saving, like in your case, $1,000 a month in my housing expense, which is usually the largest expense for any individual. Like that's huge. And that's $1,000 a month that you could put into other investments. You could save it. You can save for the next property, etc. So I think making it like a lot more simple, kind of like what you did accidentally, I guess. Like you just didn't really know what to think about. You just thought about numbers, which is a smart way to do it. That's how we should like get started. And then the appreciation, the depreciation, cost segregation stuff, tax strategies is like icing on the cake, right? So that's perfect. And then kind of doing the domino effect type investing. So like you went from a 2-unit to a 3 to an 8. Now I want to talk about switching from the residential to like the 8. So like 1 to 4 units are considered residential, right? And then you switch anything 5 units and higher to like commercial. When you got to that point, was there anything that flipped in your mind that was like, hey, this strategy is a little bit different? Like it's more numbers based, more net operating income oriented. Like what did you learn in that aspect? Or did you just kind of jump in and then you realized it? Or were you reading to learn about it and understand how you can like really force appreciate those properties a little bit more? Dive into that a little bit, because a lot of people's goals are to get into that. They just don't understand like the slow roll growth to get into there, or don't really understand the difference between like smaller multifamily and bigger multifamily.
Yeah, listen, to your point, I think getting started, you got to simplify it, because this can get really, really complicated easy. And I'm a dude that went to a state school. So like if it's overly complicated, I'm probably not going to be able to get started, right? I'm smart, but it takes me a minute to really understand concepts and understand how to apply it for my own needs. So the 2-unit, it was simple, right? I mean, at the end of the day, I need a place to live and I could save $1,000 if I did it this way. But that gave me the ability to really dive in to understand the numbers. What other expenses did I not factor in when I was running that little easier understanding of my numbers, right? I didn't plan for repairs and maintenance. I didn't plan for property management expenses. I didn't plan for some of these other things. So on the next deal, scale, I had to start factoring those things in, right? And I wasn't living at the property. So this next investment had to be a real investment. It had to actually return profits on my investment. And once that one worked out, then we started to look at the 8-unit. And now you're talking about a completely different ball game. It's different in the way it's valued. It's different in the way you apply for the loan, the kind of banks that are going to lend on this property. Everything is different. I remember one of the things that surprised me is I didn't realize the city didn't pay for trash because on my residential properties, that's included in your taxes, right? So they would pick up the trash. When you get to 5+, at least in Chicago, that wasn't included. So I had to go out and get my own trash contract, which I didn't know I had to do. So there are things like that there's certainly a bit of a learning curve, but the numbers, it's similar, but there's certainly some differences. I think the more important thing though is two things that happened for me. One, I didn't have the same energy and joy when I bought the 8-unit building. And the reason was I could only think about how long it was going to take me to get the next one, how much money I was going to have to save and how long the process was. I knew this thing was working, but I was limited based on the amount of money I had saved in my own bank account. And it was frustrating because you have something that's working, you're trying to create wealth, you're trying to grow, you're trying to scale, but it takes a year and a half, 2 years to save that kind of money. So it's not even the point of looking at deals, right? I'm like, let me just get on the grind and hopefully we can keep saving these nickels and living below our means and not drinking Starbucks and whatever it is, right? And you're just trying to save every dollar you can. And it can get depressing and dejecting after a while, especially because you save all this money. I made the investment. My bank account went back to zero. So on paper, I mean, it sounds good to say, oh, I got all these properties or whatever. But my bank account said I was dead broke, right? And at the same time, the company I was working for ended up going into bankruptcy. And at that moment, I just felt lost because I knew I was doing the right thing, investing in these properties, building this portfolio. But again, I'm looking at my bank account and now I don't have a job. I don't have the confidence that I'm going to get paid. And I just started stressing out, man. And there's this saying that, when a student is ready, the teacher will appear. And at the time, I remember talking to a good friend of mine just before this kind of went down. And she had scaled her portfolio from 3 units to 9 and then from 9 to 90. And I just remember taking her to breakfast and saying, how in the world did you do that? And in short, she told me she started working with other investors in OPM, other people's money. And I had heard of that. I was familiar with it. I didn't think it was for me. People like me don't do that. That's for people who grow up around money. You got rich friends from college, rich friends from high school. Your dad was a CEO or something like that. That's who that was for. Not people like me. I'm the first one in my family to go to school. Like that wasn't something that I felt I could do. And part of it was because I didn't have that network. The other part of it though was even if I did have that network, I wasn't confident in my own abilities to identify deals, to raise the money, to execute on the deals. So it just didn't feel like the kind of thing I should be pursuing at all. But when I heard her talk about it, it was the first time it attainable to me because I watched her grow and scale. And I know she didn't necessarily come from people who were just throwing money at her. She actually networked to build these relationships. And about a couple months later, I ended up meeting a guy who became my mentor. And this was a time when I knew I was ready to scale. I just bought this 8-unit building and this guy had raised $1 million for a $6 million project that he did himself. And I was like, wow, well, if he can do that, maybe he can teach me to raise a tenth of that, right? If I can raise $100,000 instead of me having to save 130 or 150, man, I could really grow and scale a lot faster. So I ended up hiring him as my mentor and coach. And I mean, that was the day I really decided I wanted to have more control over my financial future. Now, again, my job situation is murky. No idea what's going on there. I know this real estate thing is working, but the way I'm doing it's not quite working exactly how I thought. And then I hired this coach and mentor and I learned about apartment syndication, which I had never heard of before. Fast forward, I watched him grow and scale his portfolio. I started to ask better questions about, oh, why'd you do that? How do you do this? And I met guys from his network, his other coaching clients that I ended up partnering with. And I partnered with them on my first syndication deal. It was 192 units in San Antonio, Texas. And that was the first time I'd raised money for real estate. That was the first time I'd been involved in a much larger deal like this. And it really just opened up the doors and allowed me to scale. And ever since that day, I didn't look back. We just started to focus on finding deals, building relationships with investors, understanding what investors are looking for. And it all comes from networking, building relationships, but also just listening to people. And if you can do that, you can scale and grow a portfolio.
Yeah. And you touched on it a little bit. It's kind of like people call it like imposter syndrome type mindset, right? Like you start, like you were doing the real estate investing, you're being successful at it. But when someone mentioned, hey, I'm just using other people's money, I'm just raising capital to do it, in your mind, you're like, I can't do that. But you're already doing it. The only difference is you're now using someone else's money to make them money and yourself. You just need to execute the same things again and again. And I think that's one of the biggest barriers barriers for people to take that next step is just by thinking that that's not for them. They can't do that, lack of confidence because they just haven't done it before. But that's why it's super important to network, meet other people that are doing it, because most people that are doing that want to network and they want to become partners with other people that are like-minded. And it's amazing what you can do from just talking to other people, networking, like you said, like meeting other people that were using your same mentor or coach. And once you did one deal, like it's funny that you in your mind, it's almost the floodgates open and you're like, oh, I can do anything. Like no more imposter syndrome, like no more barriers. Let's just go.
To an extent, I would say the imposter syndrome, it doesn't necessarily just go away. It just changes, right? I mean, it just ladders up. Okay, you did that, but you can't do this, right? It just, it starts to morph and reposition itself into other aspects. But I think it's important because what happens, and this is true no matter where you're at in your investing journey, you have to recognize the wins that you've already achieved. And for me, that was the biggest thing. And when I'm coaching clients or in my mastermind, this is something I tell everybody. One of the first steps is you have to take a look at your resume. What have you accomplished? Because you have to convince yourself before you can talk to anybody else. And sometimes we got to hype ourselves up and we don't do that enough. It's great to be humble, but if you don't recognize your abilities and your capabilities, it's going to be hard to quiet that voice in the back of your head when it's trying to tell you can't do something. So I had to do that. I had to go back to my marketing days and say, you know what? You managed $100 million advertising budget. You managed 7 agency partners. You were recognized as one of the top advertising and marketing professionals in the country. You've led major brand campaigns. You've been awarded and recognized for these campaigns. You've led internal teams. You've helped young people get promoted. Like when you start to really recognize the wins you've had, now it's a matter of, okay, how can these skills apply and transfer for this new opportunity? Because what happens to a lot of people is we define ourselves based on our career. I'm a marketer. I'm a CPA. I'm a this, I'm a that, right? Usually by the job. So then when you try to do something different, there's a disconnect because that's not even who you identify as. When you go out and meet somebody, what's the first thing you say? Most people tell them, hey, I'm John. Oh, what do you do? That's the first question people ask. Oh, what do you do, John? And whatever you say back is how you identify yourself, right? That is the story you've made to yourself. Most people don't walk around saying, oh, I'm a dad. They'll say the career, the job title, maybe I'm an investor or an entrepreneur, but they don't go into, oh, I'm a football fan, right? Like if you met someone and they said, oh, what do you do? I'm a football fan. You'd be like, oh, this is lazy. Like, it's just a different vibe. You wouldn't take that, but that's the expectation of people, right? So how do you identify yourself? And that's where that imposter syndrome kicks in, because if you've identified yourself based on your corporate career, then when you're trying to do something else, it becomes harder for you to make that connection, which means it's going to be way harder for someone else to make that connection. And that's why personal branding is so important, because you've got to tell yourself the story that you want others to understand. Like today, as we're sitting here, most people know me as a real estate investor. 8-9 years ago, that was not the case. Most people knew me as a marketer. So to transition how people saw me, even close friends and family, that took a lot of time. But once you're able to do that, now you can go out and build the other things you want to do. And it takes a little bit of intentionality. But I would also say if you are surrounding yourself with the right people, again, coaches and mentors come in big here. If you're surrounding yourself with the right people, and if this is something you want to do, it's important for you to invest in yourself and invest in both your mentality, your mindset, the actual execution of what you're trying to do so that you can go out into the marketplace and get the results you're looking for.
Yeah. And that reminds me of a book that I read called The Gap and the Gain. Because I think one of the biggest struggles, one of the biggest struggles with entrepreneurship is you're always chasing that kind of next thing. It's just the mindset of people that are running their own businesses. You just always want the next thing. You like reach your goal and you're like, cool, that was awesome. When's the next thing? You never like look back and say like, where did I come from? How much have I gained or whatever, right? You always focus on the gap of like where you want to be. But it's important to look back and like just be grateful for what you came from and how much you've gone through so far, because then that alone will change your mindset, hype yourself up a little bit and allow you to have the confidence to kind of not feel that imposter syndrome and take that next step. Because say for you, like you went from not having an investment property at all to now having 145 million, right? Who says like, if someone comes up to you and is like, hey, we're trying to buy this like $2 billion real estate portfolio, like mine would probably be like, Jesus. Like I only got 145 million. That's like 20x what I got. Like, you know what I mean? But then if you look back and you're like, hey, I went from 0 to 145 million. That gap is like bigger than 125 million to 2 billion. It's like, it's just all about like being grateful, switching your mindset, which you mentioned, like coaches, mentors, books, podcasts, things that talk about just yourself and building that base of your self-confidence is super important as you like continue to grow and just enhance your career more and more. And I think that's when people get lost. They get lost in that and forget about that as they go on their entrepreneurial journey. And that's usually the downfall in the end. So it's super important. I love that you brought that up.
Yeah, I want to comment real quick on what you just said, because it's a huge point. When you talk about the gap in the gain, the whole philosophy there is to recognize the growth you've made. And for your listeners, even listening to a podcast like this, like you may not have any real estate in your portfolio today. So that imposter syndrome might be loud. But what have you learned over the last 3 months, 6 months? Like what gains have you had? I remember talking to a really good friend of mine just on my drive up, and he's under contract on an Airbnb property in Ohio where he grew up. And this is going to be his second Airbnb property. And I found out just chatting with, this is a guy who listened to my podcast, used to ask me what's a cap rate. Like we would get into all these conversations. He's invested with me on a couple of deals, and he's now kind of gone off and building up his own portfolio to the point where he's not even checking in with his real estate, quote unquote, expert buddy. He feels confident enough to go out and do it. But it comes back to that notion of, well, he started in a place where he didn't know anything about real estate investing. And then he gained a little bit of knowledge from listening to podcasts, started reading more articles, eventually got on bigger pockets and started reading books, and then eventually started to invest passively with me. And that's the point of the gap in the gain, is it's easy to realize, to just focus on, well, I haven't done it, or I can't do it, or to have this mindset of just shutting it down. But you have probably made growth and taken steps forward. You may not have the results or anything tangible to show somebody else, but even reading a book, reading an article, listening to a podcast, like you are putting in the work and taking the steps to grow and scale your real estate portfolio. But most people don't recognize that. And they don't recognize that gain because they're like, well, I still don't have a property. And if you focus only on the property or the end result, it's going to be a lot harder for you to have that continual success because the motivation is not going to be there because you're not seeing the growth. It's just like if you're trying to lose weight and you're like, all right, I'll lose 20 pounds, but you never step on a scale to see how you're progressing, right? And you just wake up 6 months from now and step on the scale and say, oh, I didn't lose anything. It's like, no, this has to be a daily, weekly, monthly thing that you are tracking to see, am I making progress? And ultimately, when you look back at where you started, you will see how much you've actually grown. And that's so important. And the reason I say that is the very first podcast I did when I met my mentor, he hosted me on his show. My mentor's a guy named Joe Fairless, built a $2.7 billion real estate portfolio, one of the godfathers of the syndication space. And he had me on his podcast. And I was right in that inflection point. I just bought that 8-unit building. So I had 13 properties. And I remember he and I just had a conversation like you are now. The episode came out and he titled it 3 Deals. I think he put 3 deals in 3 years, $1.5 million, or 13 units in 3 years, $1.5 million portfolio. I myself had never even framed it like that in my head. I didn't know it was a $1.5 million portfolio until I saw it in his show, in his subject line or his title for the episode. I was like, oh my God, we've done over $1 million in real estate. I didn't know it. I didn't process it, right? Because I'm on this hamster wheel trying to grow and scale, and like, oh man, I'm looking at my account. I got no money in the account.
Yeah.
And here I am looking at this headline that I've actually acquired $1.5 million, right? So you've got to recognize the growth because that keeps you going. And if you need the little dopamine or the little bit of hits of progress, like that gets you to the next one. That $1.5 million that gets you to the 5, that'll get you to the 10, that'll get you to wherever you're trying to go. But you can't wake up and just say, I want to build $100 million portfolio. You can, but that's really, really hard. It's much easier to say, okay, how do I take steps towards that? And what are the wins that I can get credit for along the path so that I know I am moving and progressing the right way?
Yep. That's why I like tracking your habits, or what I do is it's like a power 5 list where I do like 5 important tasks every day and I write them down, or I have an app that you put them in. It's super important to do that because as you do it, you can look back and be like, where did I start and how far have I gone? You can look back and see like what you've checked off because you're like, wow, I'm progressing. Because real estate's it's a slower game. So I know social media makes it seem like, hey, you can go from 0 to millionaire in 2 seconds, buy my course. But like it's a slow game. It's a wealth building route that does take some time. And you just have to really remember that and keep doing the daily tasks and the important steps to get there. So I love that you mentioned that. And I love that you kind of simplified and broke down the gap and the gain, because I think partially it is social media that kind of gets people in the bad headspace because they see everybody posting their highlights. They're like, why can't I be there? And like, it seems like people are overnight successes, but they were working for like 10, 15 years before they even got to the point they are. They just don't show that, right? So it kind of messes with with you. But you just got to remember that it takes a bit. You got to keep moving forward and just keep doing the right tasks every single day. Speaking of that, I want to dive a little bit more deeper into like kind of how you run your business. Let's just talk about maybe like a current project or deal that you got going on, and we can try to dumb it down as much as possible. But I want to get an idea of how did you approach purchasing the property? Like what kind of team just do you have in place? Because I know you have $145 million or 150 plus of in your portfolio now. Like you can't handle that all yourself. You have to hire teams and have systems, etc. Break down a little bit broadly, like how you kind of built that out and your process to purchase just to like simplify for people listening that might want to go the syndication route eventually, and they just try to make it seem like it's realistic for them, right? Which it is.
Yeah.
Realistic. Everybody can do it.
Yeah, it's definitely available to most people. So first of all, we sold off some of that. So I would say we've got about maybe 50 or so million in the portfolio now. We sold off probably about 100 million or so. On the day-to-day, the way we approach a deal, first of all, for us, and let's talk high level, it comes down to understand what you're looking for, right? So most people are going to start in the acquisitions phase of looking for deals and opportunities, getting a deal pipeline going. So you have to know what you're looking for. And for us, because we work with other investors, that starts by understanding what kind of returns are they looking for. So we kind of identified that. We want to have our deal criteria. I just released a YouTube video that kind of breaks this down too, but you want to start with what's my deal criteria? What's my return criteria? Those are two separate things, but very, very related. They have to be related and almost intertwined because you may be unrealistic. If you want a brand new A-class property that delivers 12% cash on cash return annually out of the gate, good luck. And if you find it, call me. I want it too. I don't think they exist. They don't exist, right? So you can have the returns you want, but then you have to understand the kind of real estate projects or deals that exist and then marry the two. So if you really want class A, easy to manage, then you're going to have to settle for lower returns, right? Maybe 4, 5, 6% returns, cash on cash, but easier to manage, right? Versus if you really want the 12% return, you're probably going to focus on lower quality properties, older properties, less desirable locations, properties where they need a lot more work. And if you're fine with that, there's nothing wrong with it, right? But that's up to every individual. Every investor is different. I know people who only like the class A stuff. I know folks who only deal with the hairy deals where they want it to be a distressed asset. So start with your deal criteria. From there, the next step for us is to understand our markets, what we're looking for, how we're going to implement and execute our business plan. So now we can start to look for deals. Okay. We're sourcing deals and opportunities. For us, we just closed on 132 units in Columbus a couple months ago. And that was a deal where it was a nice blend. Generally speaking, for us, we like a blend of cash flow, equity upside, and desirability. So we like kind of B-class assets, properties that were built in like the 80s, the 90s, the early 2000s, where structurally they're sound, maybe a little bit dated as far as the units, but the building itself is structurally sound. It could use light to medium upgrade and renovations and finishes. We want to be in desirable locations, not necessarily class A, luxurious or anything like that, but still desirable. So think about the kind of places where if you were a professional, as a teacher, a firefighter, any of our working class professionals, the kind of places they would want to live, a place where you want to send your kids to these schools. I'm not talking top end private schools necessarily, but really good city schools, public schools. Those are kind of the areas where we're looking at, right? And we want to have a business plan where we can drive value. That's really, really important for us. The technical term is value add. But for me, what I really like to think about is, do I have a way where we can control the value or creating value? And usually that's going to come in the form of increasing rents. But there are other things you can do too. But if you can renovate the units, if you can make them nicer, if you can add some amenities, and if people would be willing to pay more to live there, if you do these things, now you're creating value. So that's typically what we like to look at. So with that 132 units, that's exactly what we were doing. We found a property, had been a little bit outdated, could use some renovations, some refreshes to the interior units. Some of the exterior stuff could use a little bit of renovation and refreshing as well. So that's what we're doing now. We're starting to implement our business plan, and over the course of, call it, a year and a half to 2 years, we'll get through the majority of our business plan to increase the rents, create a more thriving community, update it for 2025 and 2026, and we'll be able to drive returns for our investors.
Love that. Yeah, because it's like two different approaches you can do. Is everybody talks about like value add investing, and that's kind of the approach that you guys are doing. And that's where you can force more appreciation, can force some equity into it by raising rents, cosmetically upgrading all the units. And it's not like, it sounds like you're not really trying to do complete overhauls. It's more just cosmetic improvements, which are a lot easier to deal with because it's more like cookie cutter, like go in, make the kitchen better, bathroom better, floors, paint, fixtures. And then it's like next, right? And that alone will increase the rents, which then increase the NOI of the property, which increase the valuation, which makes everybody happy and the investors are happy. Everybody's smiling. But yeah, there's those. And then there's the ones that are like already done, like new build construction, apartment complexes that more private, I guess, family owned offices and stuff are buying that get like 3, 4, or 5% returns, but they're just done. Like you're not going to do anything with them really. You just fill them, manage them, and you get a nice return that appreciates as long as you hold it. But yeah, there's two different aspects of there. And I would say like the value add is probably, if you want to make money faster in real estate, that's probably the best way because you can force appreciation and equity, but it is more work, right? You got to have teams in place, property managers, you got to have a business plan. You're going to deal with headaches, vacancies. You're going to deal with a ton of renovation. You have to deal with lending and making sure that you get construction loans as well as your purchase loan, like combined. So it gets a little bit more tricky there, but it is one of the best ways to increase your equity and wealth in real estate, especially nowadays. And something popped into my mind I wanted to ask you, and I just totally forgot. I hate when that happens. But oh yeah, here it is. So yeah, so you talked about kind of like your approach of what you like to buy and stuff. And I wanted to backtrack it all the way to where you hopped on that deal with like the other partner that was also working with your mentor. Now, would you say if you want to get into apartment syndications and kind of grow into that niche, would you say that trying to get into a deal by bringing some aspect like that way is the best way to kind of get going so you can build a track record and then you can start raising capital? Or would you say that like it's better to kind of find a deal, bring it to like a experienced investor that has done it? How would you find, what would you say is the best way to get into it and get started? Because I know you need a track record to work with banks. You need a track record to like raise money. Usually not investors not just going to give you money if you haven't done it before. So for someone that's trying to get into it and just doesn't know how to like even have that conversation or get started, like what would you say is the best way? From now an experienced syndicator, like if someone was new, say I was new and I just wanted to get into it, like what could I provide you to be able to get within a deal? Maybe not get any percentage or anything, but have the track record to learn and be able to then take that momentum into doing it myself. I'm getting that? I don't know if that question made a lot of sense, but
it makes total sense. How do I get started? That's the question. How do I get started in multifamily syndication? You said it differently, but I mean, that's the question at its core, right? The best way to get started is through a self-assessment. What are your skills? What are your advantages? What do you bring to the table? What can you leverage there? And the reason this is important is because we all have a unique situation. You may have capital. You may have a great W-2 job. You may have a powerful network. You may have all the time in the world because you're unemployed, right? You may have great data analytical skills and be a Excel wizard, right? So what skills do you bring to the table? Are you a great salesman? Do you have commercial real estate experience? Do you understand construction? So start with a self-assessment. What value would you bring to others? And I would use that skill set, whatever you bring to the table that allows you to stand out. That's what I would leverage. And for some people, it may be capital. And in that case, I might start off as a limited partner. I might invest passively in a deal with the intention of learning more about it, gaining that experience as an LP investor, and then transitioning that to the active side of the business. If I have a lot of time, but not money, I may work on as a deal hunter, right? I might look for deals and try to find operators and say, hey, can I go underwrite deals for you or bring deals? Especially if you have the analytical skills. If you have great people skills, you're a great networker. Maybe you're going to raise capital or do investor relations and bring some of that to the table. So I really think you need to lock in on when you started the question, kind of initially framed it as, hey, am I better off bringing a deal to an operator or have an operator join me in some capacity, right? I think it depends because going back to what your end game is. If you ultimately want to run your own deals, I would try to do the thing closest to that, even if that meant much smaller deals. So if it were me and I was advising one of my clients and they told me, hey, my ultimate goal is to be the operator on 200 units and up. Okay, why don't you be the operator on an 8 unit or a 10 unit or a 20 unit, right? Because you then trying to go do something different. Yes, it can help, but you're not necessarily developing that skill set that you need to be a successful operator. You can always bring in other people. You can always develop family office relationships or work with folks who have great investor relations expertise or capital or whatever the case may be. But if you're going to be the operator, you need to continue to sharpen your skills as an operator. If you're going going to be the person who focuses on bringing capital, develop that skill, develop the ability to build a track record, to build relationships, build out your CRM system, build out your networking capacity, focus on that. So I think the most important thing is understand where you're trying to go, what you actually want to do in this space, and then reverse engineer that. If I can share a short little story.
Yeah.
I think the biggest mistake I made during that time frame where we went from 8 units to that 192 unit deal, when I sat down with my friend Bree and she told me how she went from 9 to 90, the thing she told me was she only knew of 2 ways people really grew and scaled their portfolio. One was to flip houses to generate enough cash to then reinvest into larger deals. The second way was to partner with others and raise capital and just partner. I ended up deciding to do both of them. And in flipping properties, I sucked. And I sucked at flipping properties because I tried to flip properties like a white collar employee would try to flip properties. I would talk to contractors. They would tell me they would be there Wednesday and they would finish up on Friday, and I believed them.
Yeah.
So Thursday I would show up and like, hey, y'all said y'all starting yesterday. How come no one's here? Oh yeah, we're gonna start that tomorrow. What? And so you clearly can't finish tomorrow. And it went on, right? And I took people at their word, and I didn't realize you cannot manage construction the same way I would manage an advertising campaign. Because in my world, if you were in a meeting with me and you told me I was going to have creative or creative copy or ads or whatever it is, and I was going to have that Wednesday, you damn sure better have it by Wednesday, or an email or an update or a phone call. Hey man, I know I said I was going to have it Wednesday. This happened. Is it okay if I get it to you Thursday morning? And if that's a damn near a fireable offense to not deliver on a timeline like that, right, with your team, and not to explain and let people know. So I just was shocked that these people would operate in a capacity where their word meant nothing, and they didn't like something would change, and they didn't even bother to notify you. Oh, the electrician be there Tuesday, come and go. It's Wednesday. Because sometimes I will wait just to see, like, are you gonna even call me to tell me? Like, I'm here. I'm already here at the property Tuesday. I know dude's not here, and they wouldn't even call. So then when I call, oh yeah, he said something happened. His car broke down. He'll be there Friday. I'm like, so I say that to you to say I was a terrible flipper because I didn't understand the mentality shift. And then I even partnered with other folks, and I realized that also didn't work for me because they didn't understand the business side of it. So some of them knew how to do the construction, but they couldn't manage people. They couldn't manage timelines, which is the main thing I was trying to outsource. So I ended up losing money on my flip projects. So to go back to your original question, I would have been much better off focusing on the thing I wanted to do, which was buying smaller multifamily, raising a little bit of money, or quite frankly, just investing passively myself with the money I did save up, because that would have given me a chance to at least say, hey, I'm involved in these larger deals. I'm learning from this other operator. I'm seeing how they communicate with me. I'm seeing how they navigate situations. I can call and say, hey, man, I see your occupancy dipped to 88%. What's your plan to get it up to 92 to 94, 95? And I can hear from that. It would have been better for me to do that than the flip projects. The flips helped me learn about construction and things like that. But in all honesty, it also showed me that when you're doing small projects, you don't have the professionalism that I was used to. And based on my corporate background, I was used to operating in a professional way. In the smaller flip projects where the margins were super slim, that made it hard to do. On my 100+ unit deals, there's a lot of professionalism. Guess what? We talk about something on a Tuesday, they damn sure better have it on Tuesday, right? Like that's just how it operates when you're dealing with professionalism, and there's enough capital flowing around to compensate people accordingly because they recognize the importance of that. When you're just a gig, you're just somebody's project of the day, and they're going to move on next week to some other dude's project, they don't care about you, man. They just trying to get to the next check. But when you're someone's entire livelihood, when they work for this property and their entire salary comes from managing that property, you damn sure better believe you're going to get way more attention to detail. They're going to respect it. They're going to answer your calls. They're going to follow through and follow up. It's just a different business, man. So for me, that was the biggest shift and difference. So I would tell anybody, start with your end game. What do you actually want? And then reverse engineer the pathway to get there.
No, that's perfect. That is perfect. And it's funny that you say that about the fix and flipping, because like I'm building a fix and flipping company right now. And the one thing I tell people all the time is basically exactly what you just said, right? The only way that you could be successful fix and flipping is to build such a good relationship with your contractor or GC that you are a priority to them. Like you bring them deals, you bring them so much that they're like, it almost becomes a corporate setting because they're like, oh my God, like I rely on this person because not only does he give me deals, he provides me other opportunities, etc. Once you build a relationship like that, it makes it so much easier. But when you first get started fix and flipping, what you explained, oh my God, the guess and check of dealing with contractors, subcontractors, trying to figure out who you want to build a relationship relationship with. Most people don't make it buy it because it is a pain in the ass. Like it's annoying. Like so many stories like of what you explained I've gone through. But
and the thing too is like, I don't want to dissuade anybody from doing that. If that's what you're gonna do, you do it. Like if I flipped more properties, I would have been great at it, right? Because you learn all this. But I never wanted to flip. I only did it to make money to buy multifamily. So that's it. Kind of just, it was an issue that just conflated itself because I didn't really want to flip, which is why I relied on other people. They weren't as accountable. And it just, this whole thing. And I'm like, if I could go back, I never would have done it because I really wanted multifamily, and I would have been way better off just sticking to multifamily, even if it was smaller, even if it was more deep renovation multifamily, because at least that's what I was trying to learn and scale. So, but if you love flipping, by all means, go after it, but just learn from the mistakes that you make so you can get better and better.
Yeah, just treat everything that you do in real estate like it's a business, right? You can't just like do it as like a side gig. You got to go all in on it. So whether that be like fix and flipping, whether that be going into multifamily, like pick something and just go for it. And then once you like kind of get really good at it, then you can start going into other things. Yeah. I think a lot of people have shiny object syndrome in real estate too. And they're always saying like, hey, I got Airbnbs, I got fix and flips, I got multifamilies, all these things going on. But then they're never like really growing because they have way too much going on. They're getting pulled in all these different directions. So it's really important to really stick to one thing, get really good at it. And then you can kind of expand elsewhere. And that's with any type of business, right? Because otherwise you just kind of need to be, what's it called? Good at most, master of none. I don't know what the quote is, but it's something like that.
Jack of all trades, master of none.
That's it, right? Right. You just become that, and then you never really get to grow. But awesome. So I just want to wrap this up because I know you're a busy guy, and I always like to end with these last two questions. And the first question is just, what is like your favorite business book, investing book, or mindset book that just pops to your mind that you can recommend to anybody to pick up and read?
There's so many good ones, man. My favorite one is Atomic Habits because of the simplicity and the actionability, if that's a word, of the book. And what I mean is most times you read a book and you get some great insights, but you have to do stuff to actually apply anything in the book. And by the time you start to do the stuff, it's like you kind of lose a little bit of the enthusiasm. Life happens. Oh, okay, I'll try to do that tomorrow. With Atomic Habits, it makes everything as simple as the next step. And I mean, if you want to raise $1 million for a deal, you can break down what is step one. Step one literally might be call my first investor. You can do that right now, right? Or it might be write out a script or research what to say when pitching it, whatever it is, right? But the Atomic Habits breaks it down into the tiniest of steps, and more in particular, the habits of becoming the kind of person you want to be. And I think that's the other part where the book is, it's not about going back to being a real estate investor. It's not about you just waking up one day and being able to proclaim that you are now officially a real estate investor. No, it's just you do what real estate investors do.
Yeah.
And it's starting to shift your perspective, right? Where you're no longer the CPA or the whatever your day job is. You're a real estate investor. You're going to do what real estate investors do. What is that? Well, they look at real estate deals. So now you're going to wake up and you're going to go on Zillow or wherever you look at deals. You're going to analyze the deal. And that's what a real estate investor does. It's just to reframe your brain to create the habits to become the kind of person you want to be. And I just love how simple it is, how clear it is. And it's just one of the best books for anybody anyone who has a goal. It's a phenomenal book. So, and James Clear is a phenomenal writer. He does an excellent job of breaking down the concept and obviously spent a lot of time clarifying it, but it's a phenomenal, powerful book.
Yeah. And I have that book. I haven't read it yet. I think a lender sent it to me.
Dude, literally, I'm telling you, read it. When you read it now, like when we finish this, pick it up, just read 3 pages. Read the first 3 pages. And I promise you'll be like, okay. It's here. I've got these marbles on my desk. Okay. So these, if you guys are watching the video, I just dropped one. So that's bad. It's on the floor now. I've got these marbles I keep on my desk here. And this goes back to Atomic Habits. So it's creating your goals, but making them visual. And the marbles really, sorry for the background noise, they represent some of the things that I'm supposed to do on a daily basis. So some days I do it, some days I don't, but it's a visual representation of, am I doing the tasks that I'm supposed to be doing to grow my business? Okay, great. I take one marble and put it into the other bowl, right? So it's a phenomenal book, man. I mean, I can't recommend it more.
Love it. Yeah, I'm gonna have to read it. That and Buy Back Your Time. I'm trying to read right now.
That was the other one I was going to recommend. I just finished it this trip. I just drove back from Chicago this morning, and I finished the book yesterday when I was driving to Chicago. Excellent book by Dan Martell, and his YouTube channel is filled with great actionable insight. So if you're not a reader, you're more YouTube dude, Dan Martell, check him out. He's phenomenal information there.
I would say probably reading both those books at the same time is perfect, because one simplifies how you can just like kind of hire other people to give you back time. And then Atomic Habits can show you how to do that step by step. You know what I mean? Like get the mindset.
Can I give you a trifecta with it? We hit on, you mentioned The Gap and the Gain earlier. The same authors wrote Who Not How. So if you want a trifecta of books to really get you that, add Who Not How, because what that will add is instead of you trying to figure out all this stuff, you'll figure out who you can get to figure out all this stuff. And that will make your life much easier as well. So those 3 books, Who Not How, Buy Back Your Time, and then Atomic Habits, man, you put those 3 together, you got a powerful, powerful ideation of how to grow whatever you're trying to do.
Love it. I love that. Well, thank you, John. And I like to leave the floor to you at the end just to.
Was there a second question? I know I took forever answering the first one.
No, I mean, this is technically a second question, but it's kind of just like leave the floor to you. I always just ask, like, is there anything you want to tell the audience, how to meet you on social media, meetups you want to attend, charity events, business links, how to contact you, whatever, the floor is yours.
I love it, man. Listen, I think it's really about the audience, right? So if you got value out of this, I have a podcast called Multifamily Insights. You can check that out wherever you listen to podcasts. I also have a free download that may be helpful. It's 7 questions you must ask before investing in apartments. And it really gets into what to look for in a deal, the kind of things you should be using from a due diligence standpoint, really to pressure test, is this a deal or not? Do you understand the team that you're bringing on to execute or not? And that can really help you get richer in your thinking and elevate how you analyze deals. So that's available on my website, casmoncapital.com/7 questions. So check out those 2 resources. And if I can help you with anything in your real estate investing journey, I would love to hear from you.
Love it. Well, thank you, John. Thanks for taking the time to come on. It's an amazing story. You have so much experience, and the way you break stuff down is awesome. So I'm sure if someone reaches out to you, I mean, they should reach out to you because you seem very genuine as well. And it's hard to find people like that nowadays, I feel like. So appreciate you coming on. And thank you guys for listening.